Hello everyone and welcome to Learn.Invest.Achieve channel. Today we'll go over the analysis without mentioning the company's name in the beginning, but we will reveal it at the end. The reason behind making the company name mystery is to judge the investment opportunity without any bias and make it easier for us, the potential investors, to decide if we want to own a piece of this company and for how much. I want to ask you for your feedback by dropping a comment letting me know if you like this new style of hiding the company name or if we should just go back to the regular layout. And as usual, before we start, I want to remind you that this video is not financial advice and is for entertainment purposes only. Also, the source of all this data used in the analysis report is from the annual reports that you can find and download from the sec.gov website. I'll put a link at the top right of this video that explains how to find and download the annual reports or the 10K reports for any publicly traded company. Today's company is very well known in the United States and has a good operational presence worldwide. It's a large cap, 500 Fortune dividend company. As usual, we start with the last year's revenue and its sources. About 64% of 2022 revenue is from the operations in the United States. Almost 20% of the revenue is from the international operations and about 16% supply chain segment. In the next tab, we want to see the revenue growth trend and compare the relationship between the revenue and the operating expenses. The purpose of this comparison is to see how well the management is controlling the operations and if there are any crazy fluctuations in the past that discourage us from making assumptions based on the past performance. The operating expenses seem to be under control and moving with the revenue. The revenue itself is growing every year, which is something good for this company. But I want to bring your attention to a very interesting fact mentioned in the annual report about 2022 revenue. The volume of the service provided in year 2022 to the customers went down by 10.6% comparing to 2021. But the interesting thing is that the revenue increased by 3.1%. So how is that possible? In my opinion, the company increased their prices like any other company in these days due to inflation. I'm sure that the salaries, insurance, fuel, rent, and all other expenses went up for this company. So this company increased their prices to be able to continue providing the service to the customers. I think this is not a sustainable way to achieve growth because they can't increase their prices forever. So the fact that they had 10.6% less customers comparing to 2021 is the first negative issue with this company. Scrolling down to examine the free cash flow, unfortunately, as you can see, it is not consistent and fluctuated 5 times in the past 8 years. And the 2022 free cash flow is less than 2021. So this is the second negative thing about this company, and specifically that it's challenging to have growth in the free cash flow in all the years we are going to own and hold the stock of this company. So we better have a higher return on investment than usual to quickly return our initial investment, which is how much we will be paying to acquire the stock. Also, we have the 2023 Q1 report, and unfortunately, the free cash flow is less than the 2022 Q1 report by 55%. The reason for this decline is that the company had to make $1.2 billion as a pension contribution. Moving on to check the company's solvency, I'm really impressed by the debt level compared to the total assets. In 2022, it's only 28% of the total assets, while it was 40% in 2020. So it seems that the company started reducing the debt with the beginning of the increase of the interest rates to save on the interest expense, which is in my opinion a very good move if they can afford it. Scrolling down to see if the company can afford the interest expense to service the debt, we can see that in 2022 the company made 27 times the interest expense they have to make. Therefore, we can say that we don't have to worry about this company's solvency. The next thing we want to see is the outstanding shares. This company does not buy back their shares and issue very few shares every year. Don't let the graph mislead you, because even though the graph shows a huge change since 2016, but actually the increase is only 3%. So this is the third not really good or not really attractive thing about the company. And we should consider at least 0.5% increase in the outstanding shares at the end of 2023. Next, we want to look at the dividends. As we mentioned, this company is a dividend company, and the current yield is about 3.6%. So the yield should be our minimum return on investment, or at least the starting point. Also, the 2023 Q1 report shows a higher dividend compared with 2022 Q1 dividend. So this is a good or a positive thing for this company that they are increasing their dividend. The final part of this analysis report is the forecast. And after experimenting with different ratios, in my opinion, I think the PP&E, or the property, plant and equipment, to the revenue ratio is the most suitable ratio to predict the 2023 full year revenue. Because without the infrastructure that the company has, it will not be able to provide the service that they do in the United States and internationally. And once we reveal the company's name, I'm sure you can see why the company's PP&E is very important to generate the revenue. The average ratio for the past 3 years is 151%. So to be conservative in our analysis, let's assume that the PP&E to revenue ratio is only 150%. This will give us the first forecasting key, which is the revenue, that in my opinion, it will be around 101 billion. Next, we need to decide how much of that 101 billion will be free cash flow. So if you go back to the first tab and examine the free cash flow to the revenue ratio, we can see that it is all over the place. In my opinion, we should be conservative and remember that it's hard to predict the free cash flow for this company. The average for the last 3 years is 9%, and I think we should use only 8%. The next item is the outstanding shares. We should assume that this company will issue a very little number of shares during 2023. So we should increase the 2022 outstanding shares by 0.5%. Next is the discount rate. In my opinion, we should use the Treasury bill debt security interest rate for 6 or 9 months. I'll put a link at the top right of this video that shows how to find the interest rate for all different government debt securities. So please make sure to watch this video if you don't know how to look up this rate. So the discount rate we will be using is 5.17%. Finally, the return on investment ratio. It is up to the individual investor to decide how much it should be, but definitely should never be less than the dividend yield. So we'll start with 3.6%. Now, we have all the pieces of information that we need to find the intrinsic value of this company's stock. In my opinion, using 3.6% return on investment, the intrinsic value of this stock is about $248, and given the stock price is around $171, the stock is undervalued by about 31%. But I want to remind you about some facts that we found in this analysis, which is starting with the free cash flow not growing constantly. So we should reflect this risk on the return on investment. In my opinion, we should at least use 7% to return all our initial investment in about 10 years. This will give us about 127 intrinsic value per share, which makes the stock overvalued by about 34.6%. In my opinion, I will only buy the stock that I think is worth the value of what I'm paying. So I will be patient and get the stock when it gets to the right price. I can make a buy order that is open for 90 days at 127 per share. Will it go down to 127? It depends on how well or badly the company does in the coming quarters, or if a major sell-off happens that floods the market with shares, or if the hedge fund companies decide to heavily short the stock. Now let's go over what we found before revealing the name of this company. We found that the revenue is increasing for the past few years, but 2022 operations went down by 10.6%. The operating expenses are growing naturally with the revenue. The free cash flow is not consistent, so it's hard to predict. The debt to asset ratio is only 28% and it seems it will continue to decrease. The company can easily service their debt. The outstanding shares are not decreasing and there is a very small increase every year on average. The company distributes dividends with a current yield around 3.6%. The current stock price is $171 and in my opinion the intrinsic value is $127. Without knowing the name of this company, will you invest and buy its stock? Let me know in the comment section. Now we should reveal the name of this company. It's UPS or United Parcel Service with a ticker symbol UPS for their Class B common stock. UPS is an American multinational shipping and receiving and supply chain management company founded in 1907, originally known as the American Messenger Company, specializing in telegraphs. UPS has grown to become a Fortune 500 company and one of the world's largest shipping carriers. Thank you for watching this video to the end, and please consider subscribing to motivate me to make more videos.